Hello, Adrian. Despite ongoing geopolitical issues, it seems like global growth is fine. What are the drivers of that?
Well, you've got the bounce back from the government shutdown Q1, which really is a big part of that. But on top of that, you've got a pretty big boost from government spending, right? Both defense, you've got reshoring, tax cuts and subsidies, you've got energy spending. Those are all pretty big drivers in the U.S. as well as across the rest of the developed market economies. Then you've got tax cuts, right? You've got both corporate and individual tax cuts hitting this year. And if you look at the combined boost, really from spending and the tax cuts in 2026, it's looking like it's about 2% of GDP, which is very large. And then you've got all obviously private investment where the AI capex boom has been really spreading out to other areas. In fact, you just saw the May manufacturing ISM printed a very healthy 54%. So it's not just AI, it's also reshoring and other things. So all that's driving EPS growth, right, which was extraordinary in Q1. Expectations for 11, 12% came in well above that. I will say that was mostly driven, almost entirely driven by sort of the AI Mag 7 type trade. So it was a very narrowly driven picture.
That sounds like a perfect Goldilocks scenario. What risks do you see that could possibly upend that?
Well, anytime you have the entire developed world willing to run their economies hot to serve sort of geopolitical and domestic political goals, that is when, say, the security of supply is more important than the price and the efficiency of supply in terms of reshoring. It sure seems to be the case today. You really do risk inflation, and inflation has been above the Fed's target now for nearly 5 years. Most measures of inflation, core inflation, were running above, were around 3%, well before the oil price shock. And yet, the mindset among policymakers is that tariffs are a one-time pass-through, oil and gas prices are a one-time pass-through, fertilizer and food prices are a one-time pass-through, industrial metals are a one-time. Nearly every broad-based rise in commodity prices in history was followed by inflation accelerating, right? And with DM economies all fiscally stimulating, especially in the U.S., it would not surprise me at all to see a broad-based measures of inflation start to accelerate in the coming quarters.
So that seems a bit out of consensus. How do you see that playing out?
Well, anytime you got a big boost in costs, either margins get hit and then layoffs start to rise, or companies continue to pass on their cost increases. And if that happens, workers then would demand higher wages to absorb their higher living costs. So, with strong growth and low unemployment, I think we could see wage inflation picking up fairly quickly. And we saw that in 2022, despite everyone's expectations. I don't see why that can't happen this time.
And how would you respond to the counter argument around the AI driven productivity growth?
That's a really good point. The AI productivity miracle so far has been narrowly distributed within tech and select financials, the big sort of advanced financials, really the people at the cutting edge. Not nearly enough to affect overall economic data. So I am not ready to buy the story that the market is selling on sort of the productivity miracle. I do worry that inflation could cause rates to rise across the curve, and that would upset the Goldilocks narrative.
So last question is when the global value team looks at the strong earnings on the one hand, but also the high inflation risks on the other hand, how do you manage through that?
Well, we start with the premise that we want to own companies that can accommodate inflation risks. Right? We look for scarcity, resilience, sort of a privileged market position. So characteristics that, when managed prudently, may lead to an above average return on capital. And they also typically can result in pricing power, which can be a big help for a company to defend its margins when inflation drives costs up. So then, as a broader hedge, gold bullion and gold miners can potentially hedge both inflation risk from currency debasement, but also disruptions from geopolitical or macroeconomic shocks and risks. So we don't really have to do anything different to account for inflation. We try to manage that through the investment process.
Thanks very much for your time, Adrian.
My pleasure.